Okay, fantastic. Well, welcome everybody. Thank you for joining. My name is Ben Harvey. I'm a digital assets researcher at KeyRock. And today we've got a great discussion lined up for you on our recent report, which is called A New Playbook for Realizing Crypto's $5.6 billion Treasury Opportunity. The report was published as a collaboration between KeyRock, SAFE, and DL Research. So you can see that we have the right people here to kick it off. Just to give a little bit of context to anyone who might not have read the report, the headline finding is that crypto native treasuries have these institutional sized war chests, but they manage them in really early stage ways. And we think it's slightly outdated. We also found that the median protocol of the 25 that we looked at, they only put 7% of the treasury to work. So we kind of think that the gap between what's available now and what's being used is the defining treasury challenge. And that's kind of what we'll be discussing today. So let's start off with some introductions. First, we have Shantanu Gupta, who works on data at SAFE. Shantanu, do you want to introduce SAFE and what you do there?
Yeah, absolutely. So, GM everyone, I'm Shantanu. I'm repping Safe here this evening. Thanks for having me here, Ben. Also, super nice to meet you, Stan and Luke. A little about me. I do data at Safe, and my work at Safe generally ranges from product to business analytics. And to anyone who does not know Safe, we are the largest treasury management system right now. We have over $40 billion in TVL. And this particular area of dialogue where we discuss treasury analytics and capital efficiency really excites and motivates me. So looking forward to the chat we're going to have here.
Great, fantastic. Thank you, Shantanu. Why don't we kick it over to you, Stan? Could you tell us a little bit about DL Research, where you work, and what you do there?
Yes, happy to talk about that. So my name is Stan. I'm a research analyst at DL Research. We're a sister company of DeFi Llama. I think you all have heard of DeFi Llama and have looked at their data. And what we do at DL Research is we mostly write research reports. One of the largest ones we did recently was our State of DeFi report, which was also in collaboration with DeFi Llama. But we also work with a lot of different crypto projects, publishing deep dives, as well as spotlight articles. And we were also happy to collaborate with KeyRock on this report.
Yeah, great. Thank you very much, Stan. And I should say most of the data that came from this report was from DeFi Llama, so it's a nice kind of double crossover there. And then finally, Luke, you worked on growth over at Morpho. I think we'll be talking a lot about on-chain vaults and how they could be used with Treasury today. So, Luke, it'd be great if you could give us a down low on Morpho and what you do there.
Yeah, absolutely. Thanks for having me. As you mentioned, I'm on the growth team over here at Morpho. Morpho is one of the largest DeFi protocols by any metric, as well as the most trusted on-chain lending network with roughly $11 billion in deposits today. Morpho empowers all different types of businesses to embed native on-chain lending and borrowing capabilities into their platforms. So we like to think about this as the DeFi mullet implementation for different types of enterprises, institutions, wallets, exchanges, fintechs to build on-chain products directly into their sort of like Web 2 or familiar front ends. And so Morpho sort of acts as this underlying infrastructure or this network that unifies liquidity for borrow lend and for yield across all of these different end users. And so that's sort of like where we are today. And yeah, happy to get into it.
Fantastic. All right. Well, thank you, guys. Let's start with the big picture. So just a bit more context here. The report found that approximately 80% of the treasuries we looked at were held in native governance tokens. So that, 4.5, just shy of $4.5 billion that we're looking at. And also we found that nearly 60% of the observed period, 2 to 3 year period, every treasury was underground from its all-time high by more than 50%. And we kind of made that correlation between the two of obviously dictated by market events. but also that if you're holding a huge proportion of your treasury in native tokens, you're very prone to these massive drawdowns. Stan, why don't we start with you? We'll get an analyst perspective on this. So do you think that most treasury stakeholders, and by those I'm meaning the managers and maybe the governance people who are responsible for this, appreciate the extent to this drawdown exposure, or does it only really become visible when the market turns, when we see those big drawdowns?
I think it's really like a difference between a bull market and a bear market, right? I think in a bull market, it's very much underappreciated, mostly because of the high beta that you see with ETH and Bitcoin, right? So in the case of a bull market, a lot of projects probably think that it's fine because their token is closely correlated to Bitcoin and to Ethereum. So their treasury value usually stays quite stable or it goes up. But then I think really where it should be appreciated, and I hope it does, is during a bear market, because this is already an extremely difficult time for very much every protocol in crypto, right? Like you'll probably see your TVL decrease or your revenue. And then on top of that, if your native token goes down because it's correlated with the rest of the market, also your treasury goes down. So that makes it even harder to sustain yourself, hire people, expand. So I think there it's still very much underappreciated and it should be appreciated more by many of these DAOs that are managing quite large treasuries.
No, that's exactly right. I think you kind of hit the nail on the head there. It's not just the treasury value that goes down, it's also the revenues and everything else that goes down. And suddenly, I mean, maybe not for these larger protocols, but especially for the smaller protocols, they start to think about runway. They find that actually the revenue that was being used for that runway is depleting at the same time. Shantanu, I'm interested to hear, because I know that you work with a lot of these protocols so closely. Are you seeing the same thing? Obviously, high beta, they're doing super well in bull markets, sorry, and then in bear markets, people start to think, oh, perhaps we should have thought about this slightly differently.
Yeah, no, I actually agree with Stan. And to answer your question, yeah, it only becomes visible when the market turns, in good markets, the concentration risk gets reframed as conviction, that we had conviction. But structurally, it's still, unhedged exposure if you look at it. And when I look at it from the lens of safe, purely from the lens of safe, the exposure varies a lot by the behavior of the treasury. We have multiple behavioral segments and different type of user behavior segments. They have different concentration in different type of assets. But for a large meaningful share of organization, the treasury is still heavily tied to one token outcome. My takeaway on this is that stakeholders, they often fully appreciate drawdown exposure only when the market turns. But the best treasury operators on safe, they are already managing as if the drawdown could potentially happen tomorrow.
Mm-hmm. Yeah, no, very good. And you're right. It seems like there's that kind of clear awareness gap when we're in certain types of markets. Do you think even for the treasuries that do recognize this awareness gap, that sometimes acting on it sounds harder than it actually is, right? So one of the people that we interviewed for the report was Baptiste Cota from Midas, and he described this issue really well, where it's essentially like a circular incentive problem, which is when diversifying away from your governance token, which typically requires a governance process, then creates price pressure from the very token holders who are voting on the decision in the first place. So how should treasuries think about breaking out of this loop and maybe taking the stigma away from and reframing diversification so that it doesn't feel like such a vote of no confidence and kind of like a misalignment with the protocol itself?
Yeah, the way treasuries break this sort of problem is by, you reframe the diversification away from token sentiment and you move it more towards treasury policy. The treasury's job is not to prove loyalty to the native token; it's to secure runway and optionality for the protocol. And across our treasury, like safe users, organizations with larger stable buffers consistently show much lower operating stress than those with very thin reserves, right? And we've done analysis internally, and it shows that even a small structured shift, of 10% or 20% of native exposure into stable reserves, that can improve runway drastically. And it reduces the number of organizations sitting below critical coverage thresholds. And the other important pattern is maturity. The more sophisticated treasury operators on safe they're larger, they're older, they're more multi-owner, and they're more likely to show evidence of structured allocation behavior. And this suggests that the best way out of this problem is governance design, like you mentioned. You define those target bands, you define thresholds, and then you make diversification rules based rather than emotional. So yeah, that's my take. You break the trap when the diversification stops looking like a vote against the token and starts looking like a policy for protocol longevity.
That's really interesting. So you think if you put governance structures around it, it makes it easier to diversify rather than just saying, like, oh, there's a misalignment. You say, no, this is actually what we're here to do and we're trying to serve you. You have to codify it in there.
Yes, no, yeah, absolutely. Please do. Treasuries, they do solve the problem. When you change the decision from should we sell the token to what balance sheet policy gives the protocol the highest chance of surviving and executing through volatility. So, yeah, I mean, I feel that's the best way to, break this circular incentive problem.
Yeah. Okay. Very cool. So look, Luke, we'll bring it over to you. I mean, the diversification question, clearly, as we just discussed, is politically loaded, but there are ways to work around it. I think there's also a related angle that might be easier to enact on for perhaps some of these DAOs who don't have it so well ingrained in their policy, which is just to make what you already hold more productive. So as I said at the top, the median protocol holds just 7% of its treasury and yield-bearing positions, and this is despite the fact that we have mature infrastructure that exists at an institutional scale. Luke, I'd love to hear from somebody who's working in a protocol that's actively trying to get people to deploy into these yield-bearing positions. What do you think is holding back these huge treasuries from actually going in on-chain and looking at these proven infrastructure plays?
Yeah, so there's actually a few different things I would want to touch on for this. First off, I want to say something that's really interesting that has historically been sort of overlooked or just hasn't really been utilized by the crypto industry writ large is this idea of debt financing and really sort of like venture debt as a concept, or really just debt within the overall capital structure of the average crypto project, protocol, what have you. It's basically an industry that's 100% reliant on quote unquote like equity financing as opposed to debt financing, which if you look into the traditional world and any other industry, the majority of the capital stack is going to be debt financing for basically every other industry out there. Like maybe it's not the case for technology, but like right now with all of the CapEx that's happening in tech writ large, you're actually seeing an increase in borrowing from large tech companies and from really like the broader universe of corporates and treasuries out there. And so I think that's something that I'm excited about, and something that previously I had worked at Maple Finance, and we actually did some pretty cool deals with certain treasuries where they were able to borrow against native tokens and lock in a fixed rate on a stablecoin borrow and a stablecoin loan or a credit line to draw down against their treasury and use that as cash to balance sheet, use that for general corporate purposes, as we would call it in TradFi. And so that is something that I am optimistic on, especially as we approach the next iteration of the Morpho protocol, our fixed rate protocol, within the next couple of months here. I think that's something that's really exciting, especially with the curator model that we have, where a lot of the curators on Morpho today, including someone like a Kirok, are very familiar with these treasuries, right? Have worked on sort of treasury management with these projects and protocols for many years, and these DAOs. And so they'll have some familiarity and probably some ability to extend that type of fixed rate lending to treasuries. So that's one thing. The other one is some of the larger treasuries are not just holding, native tokens, they're holding majors, they're holding BTC and ETH. And so actually today we do work with some treasuries who are borrowing against, their BTC or their ETH on Morpho at a very cheap cost of capital. And so that's another way that a treasury can come and get access to dollar liquidity, stablecoin liquidity at, call it 3% today. Again, and something that is just another tool in the toolkit for managing runway and managing, general cash on the balance sheet. And then the secondary side of that is sort of the lending and yield generation side. So thinking about stable coins that are sitting in treasuries, generating yields, and sort of extending your runway out that way. Like, it's pretty meaningful in terms of the yield that you can sort of generate. And the beauty of Morpho for this is the platform allows for a full expression of the risk curve. And so the most conservative lending opportunities in all of DeFi, lending just against Bitcoin and ETH-backed collaterals, are available on Morpho. So those are what we would call our prime vaults, Stakehouse USDC, for instance. And those yields are actually, relative to other lending markets, attractive on a relative basis, because other lending markets have been, call it like 2% on stables, versus the Morpho prime vaults have kind of been in the 3 to 4% range. So you're getting a yield pickup there for capital that's sort of trapped on chain. Like, you're competitive with T-bills, but you keep that instant liquidity, and you can sort of venture out into higher yielding vaults if you so choose, or build somewhat of a blended exposure across a few different vaults or a few different curators for maybe like a mid single digit blended yield.
Mm-hmm. That's fascinating. I mean, I want to come back onto the fixed rate stuff, because I think that's really important for some of these treasuries. But I was going to ask, what do you think at Morpho there's there in terms of infrastructure that's really set up for these treasuries, right? I think I've seen recently in V2, and excuse me if you've renamed it, I can't remember, but there's a lot of customizability there, and there's things that you could set up. I mean, you just mentioned the instant liquidity, or the ability to kind of chop and change your risk up. Are these the kind of things that you're talking about?
Yeah, that's absolutely one part of it. The other part of it is just the venues that you're able to access Morpho yields today. So Safe, for instance, you can access Morpho yields directly from Safe. You can access Morpho yields directly from Anchorage within the qualified custodian. That's the first earn integration with Anchorage. Obviously, they have a US bank charter now. There are a lot of treasuries that are keeping their stables and custodying funds with the likes of an Anchorage. And so the ability to actually access on-chain yields and have a different menu of earn options sort of downstream of all the opportunities that exist on Morpho and exist on chain today, being able to get access to that through a Safe or an Anchorage is a huge unlock for some of these treasuries. And so those are some of the newer developments and some of the new infrastructure that's been built out to allow some of this capital to start generating yield.
Okay, fascinating. And then just to touch on the first point you made there, those fixed rate yields are going to be a complete game changer, right? Because if you are borrowing against your Aave token or a Uni token, something else, you don't want to be sat there and getting hit with 6-7% yields when you need to be able to predictably say, okay, we're going to be able to pay this off, and we're going to be able to cover all of these operational expenses. So super excited to hear more about that when you're able to talk about it. So look, it seems like the toolkit is very much there on the Safe side, on the Morpho side, but adoption from our analysis is clearly kind of uneven at this point. In the report, we tried to group the treasuries into 3 basic archetypes based on how they're approaching it. So we had active diversifiers like the Aaves of this world. I think they had about 40% Aave position, and then ETH, Bitcoin stables that they were putting to work mostly in the Aave protocol. Then you had kind of strategic allocators. For example, someone like Arbitrum, they have their I think it's called SAFE program as well, actually, or something like that. Strap, I'm not sure. But they basically deploy into RWAs, and last time I checked, they were making about 700K a year just through deploying that. So not necessarily completely diversified, but just a small segment earning some money. And then you have these more latent giants, Optimism, Uniswap, who at least on chain are 100% in their governance token. Stan, it'd be great to get your thoughts on this. Do you think this segmentation is going to be stable long term, or are we at kind of like an inflection point where these latent giants, especially, but even the more strategic allocators, are going to be forced up this kind of risk continuum and forced to kind of professionalize their treasury management strategy?
Yeah, I do think that in the long term, definitely things will have to change there. Also, just from a sustainability perspective for a lot of these DAOs, right? Especially if we do end up in a more volatile, less predictable market. I think what you're going to see is that investors will start appreciating DAOs that do diversify, that do show more resilience during market downturns. And I think in the end, this is also going to be a question for token holders, right? As in a lot of these DAOs, they're able to vote on these policies, they're able to voice their opinion. And I think the fact that we're already seeing DAOs move away from the more traditional model of just holding their native token are the early signs of this. But I think to really get a big shift there, we'll need some key opinion leaders within these DAOs to take a stance. And also like research, like we have done with the report, is already like a great way to start these conversations within governance. So I do think it's an inflection point, but it's going to be a slow ride. I don't think it will just happen over a year, you know?
Mm-hmm. Yeah, no, completely agreed. It's funny, so when we put the article out at the start, somebody replied basically saying, yeah, this is a good point, because a lot of these companies actually don't have product market fit. I mean, you've only got like 10% of them that do, and some of them raise huge treasuries where they're not really bringing in any revenue in. So you need to be careful when you're investing in some of these governance tokens. It's essentially just a treasury play at that point, and maybe like a bit of a growth play as well. But if the PMF has died, it becomes more of a treasury play. The one thread that obviously keeps coming up in this conversation in the report is governance. And even when the financial case is clear, that treasuries need to satisfy this governance requirements that might be transparency and accountability. Shantanu, this feels very much like your territory, given that treasuries and particularly DAOs need the verifiable traceability of treasury positions. What innovations, whether it's escrowed collateral, tokenized position receipts, or something else like that, do you see as most promising for bridging the gap? And particularly anything that you're building at Safe would be great to highlight.
For me, for Safe at least, like the most promising direction is also not forcing everything fully on chain. It's making, treasury policy approvals and resulting exposures verifiable, even when the execution spans off chain and on chain components. What our Safe data shows very clearly internally is that the treasury maturity already correlates with structured authorization and operational separation. Across all the entities and treasuries that we track, only about 9% or 10% show, a multi-safe structure. But that rises quickly with complexity. Around 55% of these entities with 2 safes are segregated. And when you go to entities which have more than 6 safes, then that number is almost 90%. So this tells us that sophisticated treasury operators are already moving towards role separation, policy separations, and clearer control surfaces. And we also see that execution itself is not the main bottleneck. The median treasury deploys funds on the same day, and roughly 2/3 of them deploy within a week. So the challenge is less of can DAOs move capital and more if can stakeholders verify what was authorized, where capital sits now, and whether it remains within the mandate. And this is why I think that the most important innovations are, on-chain policy enforcement at the wallet layer. So all treasury mandates are visible and enforceable before capital starts moving. Tokenized and attestable position receipts, so off-chain or hybrid positions, can still be represented and can be verified. Proof-based reporting, where treasuries can show not just transactions but current exposure, counterparty, and risk bucket alignment. And it's also important for the governance to verify not only what happened but also who authorized to do it. And from the safe perspective, this is where this category also gets very interesting, because it's also not about just making multi-sig completely, the next step is not just multi-sig transparency, it's also making treasury policy itself very legible. What bucket the capital belongs to, who can move it, under what constraints, what guardrails exist, how are positions reported back to governance. So I think the winning model will always be hybrid, off-chain or cross-domain execution where needed, but with on-chain authorization and machine verifiable reporting. So future standard is definitely probably not everything on-chain, but it should be that everything material is provable and verifiable.
Yeah, 100%. We've seen that at KeyRock. I mean, especially with some of the option solutions. If you have to take things off chain, a lot of clients are saying we need these receipts on chain just to be able to put the whole thing in one place. So that's fascinating. Are you working with any governance like proposal structures to automate this, or building anything internally at Safe? Is there anyone you can kind of point to on that front?
At this point, I'm not sure if we're building anything specific to governance models and operations, but we are working a lot towards enabling treasuries and entities to make their operations. We want to enable more financial controllers and more protocol operational managers to streamline their operations within Safe Wallet. So there's a lot of work going on under the hood there. And as we progress, there's going to be a lot to be shared from Safe side. But specifically for governance, I can't say much right now.
Okay, we'll keep our ears out. Okay, cool. Well, look, we kind of covered the problem set. We've covered the tools and the governance constraints. I think it'd be fun to look forward now, and I want to give each of you a chance to kind of paint your picture here. The report that we all wrote concludes that idle capital will soon be seen as mismanagement rather than some kind of intentional safe default by the treasury managers. If we fast forward about 18 months, and we'll maybe start with you, Stan, what do you think a professional crypto treasury landscape actually looks like? And which protocols and approaches do you think have set the standard?
In my opinion, I think where it starts is diversifying away from the native token, and really protocols will have multiple choices there. But I think the safest bet would be to look at stable coins and RWAs as a buffer. And then Bitcoin and Ethereum could act as a beta to their native token. How they're going to decide those allocations obviously depends on their risk profile and how long they think they'll have runway. But that diversification will have to happen, in my opinion, especially if protocols want to be sustainable for the long term. And then on top of that, I think you'll have what Luke also mentioned, protocols both looking to borrow against their native token for runway, as well as potentially ways to earn yield with RWAs or ways to earn yield with stablecoins. So a very simple thing is using Morpho, for example, or some of these vaults that risk creators have offered in the past. And I think also you could look at more complex strategies, of course, to hedge exposure or look at things like options. But I think that will happen more down the line. I think where it should start is more these simple strategies that are also easily explained to token holders and happen on-chain. And then later down the line, you can look at more off-chain strategies that are potentially more complex, but also potentially more rewarding for these DAOs.
Mm-hmm. Yeah, I completely agree. I could definitely see a world in which, a treasury is buying maybe USCY, circles yield breading, kind of RWA position, and then using that as collateral to then go and buy options and things like this. So I think that's fascinating. Luke, would you like to tell us where you think we're going to be in 18 months?
Yeah, I think the existing trends just continue to gain momentum and sort of grow and expand over time. I would say from us, like, we are really excited about the fixed rate lending protocol, what previously had been referred to as Morpho v2, but really is a natural complement and extension of Morpho Blue, which is the variable rate markets protocol that exists today, and our ability to bootstrap the largest, deepest, most robust fixed rate lending market anywhere on chain. And the strategy that we've rolled out to doing that is based around our upgrade to Morpho Vaults. And so within the past several months, we rolled out Vaults V2, which today, are commanding a couple $2 billion of deposits. And so on day one, as the fixed rate protocol goes live, Morpho Vaults V2 are going to be forward compatible with that, as well as any future versions of the protocol. So that liquidity bootstrapping effort and liquidity migration effort that is usually the most challenging piece of rolling out and upgrading a lending protocol is already kind of taken care of in some sense. And we're really excited that we'll be going live with billions of dollars of liquidity on day one for the fixed rate protocol. And really that focus has been informed by discussions over the past 1 to 2 years with large institutions, with treasuries, with enterprises, with all of these different types of players that are now getting involved in the space and sort of downstream of broader stablecoin adoption, looking at DeFi lending, looking at on-chain yield, looking at all of the potential solutions that they could build on top of Morpho. And a very persistent sort of requirement or feature that has been requested has been this fixed rate and sort of like fixed term lending primitive. And so that's something that we just see tremendous demand for. We also just see a absolute glut of stablecoins coming our way. So I think, in the tens of billions of dollars immediate supply, immediate line of sight into tens of billions of dollars of stablecoin supply, this year and into 2027. And then really it's just an expansion of the yield universe and the types of assets and the types of strategies that on-chain allocators are going to have access to and going to have at their fingertips. And I think there's a large role that AI and sort of like agentic capital management and capital allocation is going to play in that. And I think that is such a natural fit for Morpho, and the way that we're already seeing curators utilizing AI agents on Morpho today is pretty exciting, I think. So if you just look at the natural trajectory of the improvements in AI and where that's going to be in 18 months, as well as the adoption of stablecoins, as well as like, hopefully clarity gets passed this year and there's, we finally have rules of the road on market structure and all of these different things coming together. I think it paints a very exciting picture for where Morpho and where DeFi writ large will be, in 2027, 2028 timeframe.
100%. And it's good to hear that there's not going to be any 30 mil capacities when you go live with your fixed rate deposit. That will be one to watch on the day. I'm curious, when you're talking about institutional vaults and these kind of treasuries to come to you, Luke, obviously you've got Bitwise and some of the big players on there. Is anybody asking for KYC and that kind of thing? Just to hearing you talk about the AI and the agentic commerce that's coming onto Morpho, I'm starting to think, alarm bells with those kind of players being involved, or are they not too interested in that side of things just yet?
No, I mean, to your point, it is still a little bit early, but we're definitely getting questions about that. And the beauty of Vaults V2 and Morpho, particularly with the fixed rate protocol, next iteration of the protocol, is you can build in sort of KYC or any permissioning on either side of the market. So either at the vault level or actually at the borrow market level within the fixed rate protocol as well. And so It's very flexible infrastructure that can be customized for the needs of any entity within any regulatory jurisdiction around the world.
Very cool. Yeah, well, we're big fans of Morpho at QRock. Shantanu, do you want to wrap it up for us? Where do you think we're going to be in when it's 18 months time?
Yeah, no, internally we are very bullish, and the way we are working, the products that we want to build, we want to change how professionalized crypto treasury. We don't want them to look like passive wallets anymore. We want people to utilize their funds. We want them to use their treasuries more like an operating balance sheet of sorts. And there is a strong signal internally when I look at safe data. And the sophistication also rises sharply with the treasury scale. With treasuries that hold more than $10 million, over 70% of them fall into treasury orchestration. Larger treasuries are also much more likelier to separate reserve and strategic capital. So that suggests that the standard over the next 18 months will probably not be defined who takes the most risk. It will probably be defined by who builds the most repeatable treasury operating model, where there's a clear separation of operating reserve and strategic capital. They have delegated execution within guardrails. There's regular rebalancing and reporting, and there's decent deployment of low risk idle balances. And right now we feel the market is also slightly early, where a very small percentage of these treasuries interact with on-chain yield when used monthly. So the baseline is still far away from professionalized, but the shape of the future is already pretty visible inside the more advanced cohorts internally. More than almost 1/3 of the wallets with idle stablecoin balances are already deploying into low risk lending or vault strategies. And multi-safe segregation also becomes common as entities mature. So the next stage is definitely, not inventing a new treasury category from scratch. It's scaling behaviors that are already existing among the best operators. So I think the standard setters in the next 18 months will be protocols and treasury teams that probably do, three things well. One is you treat reserves, operations, and strategic exposure as distinct mandates. You make capital productive without sacrificing liquidity or governance clarity. And there's also an active measure of building, reporting, and policy discipline strong enough that treasury decisions become repeatable rather than them being largely ad hoc. So SAFE has already become the operating layer where this maturity is visible. People are moving away from custody towards policy-driven capital allocation and structured treasury execution. So the real shift, I feel, would be, is that doing nothing will stop looking prudent and it'll start looking like an unowned investment decision.
Yeah, very well said, Shantanu. Very well said. Okay, well, look, thank you very much, Dan, Luke, and Shantanu. We really appreciate you sharing your perspective today. I think what comes through clearly is that tooling isn't the problem anymore. That it's the infrastructure exists, it's battle tested, and it's at institutional scale. Now we're looking at kind of that discipline around execution and governance alignment and all of these things that we discussed today. If anybody listening hasn't read the report, I'd encourage you to do so. It's available on the QRock website. You can ask us questions. The best place to do that is probably on X. We'll respond to all of those. And in the same vein, we'd love to hear from treasury management protocol teams thinking about this. I think I speak for everybody, whether that's on the custody side, with SAFE on the vault deployment side, with Morpho or the research and data side with DL. The people on the call are the ones building the solutions. So thank you everyone for joining, and thanks to our speakers, and enjoy the rest of your day.
Thanks for having me. Have a good one.
Yes, thanks for having me. Have a great day.
Have a great day, everyone. Thank you.
Fantastic.